Janet Yellen speaks and the bears get tossed out like a dirty piece of laundry. Main Street is not aligning with Wall Street. Stay tuned for more details. Hello, this is Michael Loftus, Loftus Wealth Strategies. Welcome to Wealth and Wisdom TV, where education is the key to a successful financial future. Straight up to the numbers here, green across the board. Nasdaq, the big winner last week. So, what happened? Why did we see this jolt? Well, Janet Yellen, of course, came out and spoke. As they say, do not fight the Fed. So what did she say? Basically, because the neutral rate is currently quite low by historical standards, the federal fund rate would not have to rise all that much further to get to a neutral policy stance. So basically she's saying, we're not raising rates, let's go, put your money in the stock market, continue the party. That's basically what she said last week. Now here's the problem. When you look at it, and this Fed, to me, they've been clueless for quite some time. Here's an article this weekend from the New York Post, of all places. Janet Yellen has no idea what she's talking about. But in this article, they're mentioning inflation and her idea that we have not hit 2% inflation at this point, which is one of their targets. Now, let me ask you, in your world, how do you see inflation? I know in my world, healthcare, through the roof. Education costs, through the roof. Groceries, through the roof. We are definitely feeling inflation. So I'm not sure what they look at. I know what they're looking at. It's an old, antiquated formula is the problem. That's why this Fed is just clueless. Now, here's an article from MarketWatch last week. Stocks could crash if Yellen does not perform a miracle. What are they talking about? The unwinding of QE. I mean, when you look at the amount of money, billions and billions of dollars, how can they do this without affecting the market? I don't see it, right? And if you're looking for better insight on the Fed, here's a book that I read recently called Fed Up. Excellent book, Danielle Martino Booth, former Fed employee. She talks about the dysfunction within the Fed. Basically, you have a bunch of geeky academics that are out of touch. It is well worth the read. So, let's get right to the charts. Last week, as you would expect, we did break out. There's that box we've been showing for some time now. Let's see, we did break out before. We'll see what happens when you look at the bottom. We do have momentum pointing up, okay, on MACD. That is a positive sign. RSI still has a way to go to become oversold. So I would look to see a bounce unless something unusual comes. I think the 2,500 is probably our next target at this point. When you look at the weekly view, not a lot of change from last week. You look at the bottom with momentum. We're still in a negative cross there. We'll see if we get some change there. Now, taking out all the noise, the moving averages, the invisible moving averages, in this case, 50 blue, red 200. As long as 50 is above 200, good things happen, right? When you look at this, it tells me that we're still in a bullish uptrend at this point, but we still have some short-term volatility. Now, I saw some interesting research this weekend from Ned Davis Research, looking at some corrections. 5%, it's been 247 days. That's the longest in 20 years. 10%, 341 days. 20%, 2086. And to put things in perspective, look at it from a charting standpoint. You know, we saw it last year in Brexit, and obviously that turned around very quickly. So, you know, we have not had a 5% correction. I mean, this is the longest time in 20 years. To me, it just seems overdue. When you look at it on the 10% side, look at it here, right? We've had two, really, and then going back to the crash, okay? And here's our 20% pullbacks, which we've had 3, and I went back here the last 30 years. So we're up 235% without much of any pullbacks. To me, that is concerning and shows some of the complacency in the market. So, Nasdaq, looking here. Here's what I said last week on the Nasdaq. I look for a bounce here, especially with the earnings starting to come out this week. Well, when you look at that, that's exactly what happened. So here's our trend line. I talked about keeping our trend line last week. We fell below, but it looks like we were gathering some momentum there, and in fact we did, and broke above it again. When you look at where we are in the Nasdaq this week, same thing. We still have a way to go here. I think momentum's pulling up. You have RSI at the top, relative strength, still a little way to go to become oversold. And then at the bottom I added something new. Maybe Michelle can zoom in on this. It's Nasdaq relative to S&P. And you see it on the right hand side there starting to point up, which tells you relative to the S&P, you're seeing some better performance over the short term. Sectors, let's go back to a couple sectors we talked about. Financials last week. Not good last week, but we did jump out, saw a little bit of pullback because of not just earnings, but because of the Treasury. We'll talk about that. Biotech, here's an update. Talked about it kind of after the breakout, gathering some momentum, and yes, we saw that, and now we're pointing up. So we've got momentum up, and we are starting to go up here. So I like biotech in this area as well. So Treasuries, we've been talking about this. Here's what I said last week on Treasuries. Treasuries, my opinion, have gone way too far in a short period of time without a lot of reason. So maybe a pause and a downturn as we head into the summer. So when you look at the Treasuries right now, 233 down to 231 this morning on Monday morning. Our 10 minus 2s are at 0.98, but talked about this last week, which was 262 is your high, 242 a lower high, 239 lower high. That's what I talked about last week. And in fact, we did go under. So I still see Treasuries going a little bit lower here, especially as we head into the summer months. So looking at Main Street versus Wall Street. Here's from the Wall Street Journal this morning. Optimism in the financial markets fails to show in the real economy. Now, we've talked about this for some time with the data. The data does not align with what we're seeing with all-time highs. So first, look at last week's data. Consumer credit, $18.4 billion versus $12.9 billion. All-time high, higher than before the crash. Is that a good thing? No. Here's a chart from Northern Trader, from Twitter, and it shows you the blue line, delinquencies. You talk about an ugly trend, so we're taking out more debt, highest in all time, and delinquencies are going up. CPI, PPI, we talked about that. No inflation to be seen. Retail sales, 0.02 on the downside, looking for a 0.1. The consumer is not showing up. They're not going to be able to drive this market. Consumer sentiment came in lower, 93.1 versus 95. GDP, because of all this wonderful news, was revised from the Atlanta Fed from 2.6 to 2.4. And the last thing is Fed receipts. Take a look at this. Fed receipts. Think about it, right? Money's coming into the Fed, okay, from what? From taxes, corporations. Look at that trend line. When you see it going down, corporate receipts. So, again, another piece that concerns me. Now, volatility, we looked at that last week. All-time low again. Haven't seen these kind of numbers since 93. The complacency is what makes me a little bit uncomfortable. But you look at the cycles here, and obviously I've done a couple different colors, and you can see the cycle of where we are, and it does seem that we're going to start seeing an uptick at some point. So, wrapping things up for the week, where is the consumer? Bullish, 28.28% from AAII. Historical is 38.5. So, the consumer individuals are way off. Neutral, 42%. Bearish, 29.6. Historical, 30.5. And then Wall Street traders, 29 versus 29. Fear and Greed Index, 64. So we went up, kind of makes sense. 1 week ago, 49. Indicators. No, we did not have a change even with that surge. Our short-term indicator stays negative. Why? How could that happen? Because it's about momentum. And last week, even though we had the markets go up, volume was anemic. So, out of that, short-term negative, mid-term, long-term are positive. As always, we say what? Stay nimble, be open and ready for moves, okay? Make sure you put your stops in there, look at some of your price points, and be careful with this very much all-time high market. This is Michael Loftus, Loftus Wealth Strategies. Thank you so much for watching. Make it a great week.